Warning: why private equity is buying your life expectancy. The nurse closed the chart and whispered, "Not today." The morphine order was denied. Outside the door, a regional manager refreshed a dashboard that showed margins finally ticking up. The hospice had been acquired 6 months earlier. Families thought care would improve. Instead, services thinned, visits shortened, and a quiet spreadsheet decided which comforts were not medically necessary. To see how a moment like that gets priced before it happens, we have to rewind. Low interest rates starve big money for yield. They found it where demand is guaranteed, the last miles of life. Today, we'll map how your lifespan became someone else's return. The death yield thesis. Start with the simple shift nobody announced out loud. From healthcare to life asset management. When investors look at the end of life, they don't see just patients and families. They see a pipeline. Seniors housing on the front end. Hospice at the exit ramp. Funeral and cremation as the final toll. And for some, a last stop with medical debt buyers. Every gate in that line has price power. Put them together and you have an asset with non-discretionary demand. Here's how the math reads inside an investment memo. First, length of stay. In hospice, the per diem rate is predictable. If you can steer referrals earlier and discharge patients who need higher cost intensive care, average margins rise. In seniors housing, longer occupancy and regular rent escalators drive yield. In funerals, adding services at the moment of maximum stress lifts the ticket size. The common thread is control of time and choice. If you can predict when people enter, how long they stay, and what options they're shown, you can model cash flows like a utility. Then look at who's assembling the pieces. UnitedHealth's Optum unit has been buying the middle and the exit. It closed a $5.4 billion acquisition of LHC Group and then moved on Amedisys in a $3.3 billion deal announced and completed across 2024 to 2025. That's home health plus hospice at national scale, plugged into clinics and a pharmacy benefit manager. The strategy isn't mysterious. Capture the end-of-life spend by owning the referral funnels, the nurses, and the billing rails. Private equity saw the same map. Hospice has been one of their favorite roll-ups because it's fragmented, reimbursed by Medicare, and sensitive to length of stay and staffing mix. Owners can consolidate back offices, trim visit intensity, substitute lower-cost labor, and push for earlier admissions through hospital and primary care relationships. The problem for families is that these efficiencies show up where it hurts. In 2024, researchers from Emory University, Vanderbilt University, and while Cornell reported that hospices owned by private equity or publicly traded companies earned the lowest performance ratings and worst caregiver experiences across key measures. That's not a slogan. That's caregivers saying the care felt worse. Now connect pricing power to the rest of the pipeline. Senior living real estate investment trust structure leases with automatic rent escalators and tack on ancillary fees for care coordination, therapy, and transportation. Funeral chains quietly buy local homes and centralize cremation capacity, then raise list prices in markets with fewer competitors. When a loved one dies, families often only see one or two nearby options, both owned by the same parent. Add grief, time pressure, and opaque price sheets, and the upsell writes itself. What makes this a thesis instead of a list of deals is the yield profile. End-of-life spending doesn't slump when the economy does. Mortality has a curve. That curve is aging upward as the large mid-20th century birth cohorts move through their 70s and 80s. And the wealth is sitting right where the pipeline meets the customer. Americans 55 and older control more than $124 trillion in household wealth. To an investor, that looks like a toll road running through the richest neighborhood in the country, with traffic guaranteed. There's another lever: prediction. The more precisely owners can forecast who will enter care and when, the more tightly they can manage labor, inventory, and billing. Insurers and risk managers have upgraded mortality tables with machine learning. Academic teams, including work out of Stanford, built models that predict one-year mortality with high discrimination. Those tools don't just live in journals. They migrate into underwriting, claims management, and referral targeting. A small shift in predicted risk can reprice a book of business by billions. It also nudges which patient gets what visit, which plan requires prior authorization, and where a referral lands. Inside a private equity model, that prediction ties back to control. If you own the clinic, the home health agency, the hospice, and the pharmacy benefits, you can nudge the route. A diagnosis code here raises risk scores and captures more reimbursement. A formulary tweak there pushes a cheaper drug first. A prior authorization delay buys time while a quarter closes. None of this is a movie villain. It's a series of toggles run by people who are paid to hit targets. For families, it shows up as premiums drifting higher, surprise bills for observation status, and cremation costs that climbed faster than inflation. For nurses, it shows up as shorter visits, more patients per shift, and burnout. For small-town funeral directors, it shows up as a friendly buyer who later standardizes prices. The through line is that time, how much you have and how much you use, becomes a line item. Here's the irony most of us don't see until it's too late. The capital funding this pipeline often comes from pensions and insurers tasked with protecting retirees. Low interest rates in the 2010s and early 2020s pushed those institutions to hunt for steady, uncorrelated returns. End-of-life services promised exactly that. So the same money meant to make retirement safer helped build the machine that bills retirees and their children. It's a closed loop by design. To understand why almost every lever points the same way, we need to go back to the moment investors ran out of easy yield and started pricing certainty wherever they could find it. The yield famine that set all of this in motion. The yield famine that started it. Three things collided after the financial crisis and wouldn't let go. Rates fell and stayed low, obligations to retirees kept rising, and markets got choppy. Pension funds, insurers, and endowments needed dependable spread, not hero bets. Bonds didn't pay enough, equities swung too much, and hedge funds weren't matching actuarial math. So the mandate shifted. Find assets with cash flows you can map years out, with customers who can't opt out. That's when end of life moved from a line item to a target. Liability matching sounds dull until you see how it moves billions. A corporate pension promises checks for as long as workers live. The risk is longevity. People live longer than the spreadsheet assumes. If you can price that risk with precision and pass it to someone who wants it, you lock in predictability. That's the logic behind pension risk transfers. Employers push their pension blocks to an insurer. The insurer then reinsures that longevity exposure, often with affiliates designed for capital efficiency. By 2024 and 2025, more of that reinsurance capacity sat in platforms linked to private equity, frequently domiciled in places like Bermuda that offer lower capital charges. What sounds like a shuffle is a funnel. Retiree lifespans turn into assets managed for yield. The chase didn't stop there. Investors went hunting for cash flows that resist recessions. They call them non-discretionary. You don't decide whether a parent needs help bathing or whether a body needs cremation. You don't bargain for a hospital discharge. If you can acquire the operators who bill for those moments, and you can raise prices a few % each year, your models smooth out. That was the pitch, resilient demand with operational levers. This wasn't the first time finance turned human rhythms into securities. The pattern echoes. In the 1980s, mortgages became bonds. In the 2000s, buyouts turned companies into collateral for debt. In the 2020s, the search moved inside the body. Call it biocash, cash flows tied to diagnosis codes, admission windows, and actuarial tables. Each era learned the same lesson. When the model works, you look prescient. When it misses, you discover how quickly small errors compound. Demographics made the spreadsheets glow. The cohorts born in the 1940s through the 1960s were marching into their 70s and 80s, where healthcare spend accelerates and mortality curves steepen. That wave is measurable. It's not a guess, it's a timetable. Layer on wealth concentration, and the attraction becomes obvious. Americans aged 55 and older now hold north of $124 trillion in household wealth. That's home equity, retirement accounts, brokerage assets, the savings of a generation that benefited from rising markets and housing booms. If you place tolls across the services they must cross in their final decades, aggregate returns look dependable. The playbook that followed was familiar. Roll up fragmented providers to gain negotiating power and back-office scale. Add leverage to juice equity returns. Raise prices where customers are in distress or face few alternatives. Cut costs by adjusting staffing ratios and replacing higher-paid clinicians with cheaper labor where rules allow. Then sell the platform to the next buyer or take it public as a real estate or operating company that spins steady dividends. On paper, it's efficient. At the bedside, it's thinner. Once investors saw the math, they moved on the gatekeepers, the places where a referral starts, where a diagnosis gets coded, where a discharge gets routed. Control the funnel, and you. Shape length of stay and mix of services. That's why home health and hospice chains attracted strategic buyers like Optum, and why private equity targeted regional operators with hospital ties. Owning the rails means owning the rhythm, who gets admitted when, and how long they stay. Parallel to that consolidation, the risk markets started refining their tools. Longevity swaps and reinsurance treaties turned population life expectancy into tradable exposures. The more accurate the mortality curves, the tighter the pricing, and the more confident the capital. Advances in machine learning made those curves sharper. Academic projects, including Stanford-linked work, demonstrated high discrimination for one-year mortality using clinical and claims data. Those algorithms didn't stay in labs. They informed underwriting, reserve setting, and the valuation of whole blocks of policies and pensions. A fractional change in assumed mortality. People living 2 months longer on average, say, can swing valuation by billions across large books. Rate regimes nudged everything along. When safe bonds yielded little, the premium for certainty rose. End-of-life services, structured as leases, per diems, and fee schedules, looked like mini-infrastructure assets. Senior living REITs offered rent escalators and ancillary fees. Hospice per diems offered steady reimbursements. Funeral pricing could step up as local competition thinned. Package those features, lever them, and suddenly you've built a synthetic bond paying far more than treasuries with customers who show up regardless of GDP prints. But there's a twist that keeps getting missed. The ultimate payers, the retirees and their families, are also the capital providers. Pension funds and insurers invest into private equity funds and credit vehicles that acquire the operators who later bill those same households. Premium dollars and retirement contributions flow upstream, then return downstream as invoices and rent. It's efficient capital recycling from a spreadsheet's view. From a kitchen table, it feels like paying twice. By the late 2010s and into the mid-2020s, the famine for yield had trained an entire ecosystem to see years and diagnoses as pricing variables. The conclusion wasn't whispered, it was published in pitch decks. If you can predict and manage the last miles of life, you can deliver stable returns across cycles. And once prediction improved, the temptation to steer followed. That's the hinge. Forecasting risk is one thing. Owning the levers that change it is another. Consolidating the gateways of death. While the models sharpened in the background, the buying spree moved to the foreground. The first gates were the ones families see. The funeral home on Main Street, the hospice that sends a nurse to the living room, the senior residence with the cheerful brochure. Each looked local. Many weren't. Funeral chains learned the oldest trick in retail: control capacity and blur the brand. They bought independent homes, kept the legacy names, and centralized embalming and cremation at regional hubs. With the ovens and staff consolidated, they could ration slots and inch up prices without a public fight. Families tended to shop once, under deadline, without a clear price list. In many counties, the two different options on Google shared the same parent company. That's how list prices rose, add-ons multiplied, and the final bill crept from painful to punishing. When households asked why the cremation fee jumped again, the answer was a sympathetic shrug and a laminated price sheet. Hospice consolidation followed a similar pattern, but with a Medicare twist. Reimbursement comes as a per diem, paid for each day a patient is enrolled. That makes length of stay a profit lever and staffing a cost center. Private equity buyers stitched together regional agencies, standardized back-office systems, and then tuned the dials that drive margin, visit frequency, clinician mix, and discharge patterns. Meanwhile, strategic buyers went for scale with a different aim. UnitedHealth's Optum didn't just want a hospice, it wanted the funnel. It closed the $5.4 billion LHC Group deal and then completed a $3.3 billion acquisition of Amedisys across 2024 to 2025. That put home health and hospice under the same roof as clinics, claims analytics, and a pharmacy benefit manager. Owning the rails means you can route the train. Families felt the shift in small, accumulating frictions. A nurse who once stayed an hour now stayed 40 minutes. A weekend call rolled to a national desk that promised a callback. The hospice chaplain who knew local clergy was replaced by a rotating contractor. Care didn't vanish, it thinned. In 2024, researchers connected the dots. Teams from Emory University, Vanderbilt University, and while Cornell reported that hospices owned by private equity or publicly traded companies posted the lowest performance ratings and worst caregiver-reported experiences across key COPS measures. That's not ideology. That's families saying the experience slipped. Senior living real estate added another gate with a lock. Many operators don't own the buildings. They lease them from real estate investment trusts. Those leases often include automatic rent escalators, inflation riders, and requirements to maintain occupancy. When costs rise, fees rise. Ancillary charges, medication management, transportation, personal care become revenue lines. In a tight market, residents have few alternatives nearby. When an operator changes hands, the lease terms don't soften, they harden. A daughter trying to keep her mother in the same apartment now faces a letter announcing a 5% bump plus a care coordination fee. The choice is simple and brutal. Pay or move her mother away from friends and familiar hallways. Behind the scenes, lab and pharmacy integrations tighten capture. If the same parent controls the home health agency and the specialty pharmacy, more of each patient dollar stays inside the house. Formularies can nudge cheaper drugs first. Delivered oxygen can be billed through affiliates. Billing teams learn every reimbursement nuance, maximizing allowable codes while minimizing service intensity that doesn't move the needle. It's legal. It's also how a spreadsheet tells a bedside what to do. The market structure finished the job. In many regions, roll-ups created quiet monopolies or duopolies. Funeral homes with common ownership set the local floor on cremation. Hospices linked to hospital referral systems won most admissions. Senior residences bound by REIT leases marched prices in step. Families didn't see a monopoly flag. They saw a cluster of familiar logos that, in practice, led to one balance sheet. With fewer independent options, negotiation became ceremony. Here's the part investors rarely say out loud. Consolidation doesn't just raise prices. It narrows choices at the exact moment when choice is everything. End of life is personal, cultural, and spiritual. It needs slack, time to ask questions, space to change course, people who know the terrain. Regional scale flattens that texture. You get call centers, templated care plans, and quarterly targets that roll downhill. Meanwhile, the prediction engines kept feeding the front end. If you can forecast who's likely to need home health in 60 days, you can have the referral relationship in place. If you own the clinic and the hospice, you can steer within the rules. The machine learns, the network routes, and the margins print. Pricing power is one pillar. Prediction is the other. The two together turn the last miles of life into a managed yield. The prediction engine, pricing your lifespan. While consolidation tightened the gates, the real shift happened in the spreadsheets that guessed the future. Insurers and operators stopped relying on blunt actuarial tables and started using models that learn. Claims histories, diagnosis codes, prescription fills, lab results, even gaps in refills. Each becomes a signal. Academic teams, including work out of Stanford, showed you could predict one-year mortality with high discrimination using routine clinical data. That wasn't trivia. It was a map for money. Here's how it moves from paper to pocket. A model flags two patients with the same diagnosis. One has irregular pharmacy fills, a recent ER visit, and lives alone. The other has steady refills and regular primary care. The algorithm assigns different one-year death risks. In underwriting, that can mean different premiums or stricter terms. In Medicare Advantage, it can steer coding intensity and drive higher risk-adjusted payments. In a hospice funnel, it can nudge who gets a call first and how early. Policy lapses, people stopping premium payments, used to look like noise. Now, lapse models predict who's likely to quit based on credit signals, job changes, and adherence patterns. If an insurer expects you to lapse, it prices or markets differently. If it expects you to live longer than average, it trims margins or reinsures the tail. Wearables and wellness apps add another layer. Steps, sleep, heart rate, glucose. Data that once lived on your phone now inform a risk portrait. Even if a carrier swears it isn't underwriting with that feed, it can still segment marketing, design incentives, and quietly tilt future pricing. Medicare Advantage supercharged the game. Plans get paid more for sicker members, so documentation intensity matters. That's where diagnostic upcoding debates live. If predictive tools suggest a member's true risk is higher than records show, there's pressure to complete the profile. Each extra code unlocks higher payments. From a clinician's perspective, it's documentation. From a finance perspective, it's revenue capture. Meanwhile, prior authorization systems absorb prediction, flagging which requests are likely low value and can wait, and which denials will probably be overturned on appeal. Delay becomes a tactic. Now follow the risk to the balance sheet. Pension risk transfers move corporate pension promises to insurers, who then move longevity exposure to reinsurance affiliates, many linked to private equity and domiciled in capital-light jurisdictions like Bermuda. That's where the mortality models bite hardest. If an algorithm shifts the expected survival of a pension block by weeks, the present value of the liability moves by millions, across many blocks by billions. Longevity swaps let counterparties trade exposure to people living longer than expected. The same math that helps a hospice forecast caseload helps a reinsurer price tail risk. Life settlements sit on the same rail. Investors buy policies from seniors and pay the premiums, betting the payout will beat the carry. Predicting time to maturity is everything. Early academic mortality models that beat standard tables gave funds an edge. As machine learning spread, that edge got thin, so funds layered medical underwriting, pharmacy data, and social variables. Again, a tiny shift in expected months can swing a fund's returns. One algorithm update, one new predictor, and a settlement portfolio can reprice overnight. Here's the problem nobody puts in the brochure. Prediction always tempts control. If a model says a patient is likely to die in 6 months, and you own the clinic, home health, and hospice, you can steer appropriate care pathways that also align with reimbursement. Early engagement sounds humane, and sometimes is, but it can double as margin optimization. Formularies lean to cheaper drugs first through step therapy. Prior authorization slows escalations to higher-cost treatments. Staffing models shave minutes off visits that the algorithm deems low impact. Every toggle can be defended. Taken together, they shape outcomes. Families feel it in ways that don't look like AI. A daughter wonders why her mother's referral skipped the community hospice down the street and landed with a chain tied to her Medicare Advantage plan. A son notices the pharmacist insisting on a cheaper alternative that leaves his father groggy. A nurse gets a dashboard reminder to close out a visit at 40 minutes. None of this requires a villain. It requires incentives and a forecast. Meanwhile, the feedback loop tightens. Claims data trains the model. The model guides care pathways. The pathways shape claims. If a plan's prior authorization rules delay care that would have extended life by weeks, the mortality curve it observes will look a bit steeper next year. That sharper curve then supports tighter pricing and new denial thresholds. It's self-fulfilling unless checked. All of this lands in one sentence. A fractional change in predicted risk moves real money. Pension blocks reprice. Reinsurance treaties reset. Settlement funds mark up or down. Hospice operators tune labor. Insurers tilt premiums. The people inside those curves don't see the math. They feel the nudges, the extra form, the shorter visit, the delayed approval. Prediction was supposed to help plan care. Where incentives in the wrong hands, this is where profit. The spreadsheets meet the bedside. Hospice gets paid a flat per diem, but the cost of intensive care, continuous nursing, crisis management, can explode a budget. So the incentive tilts toward enrolling earlier when costs are light, then trimming visit intensity, and discharging when symptoms spike past what the per diem will cover. Studies in 2024 found hospices owned by private equity or publicly traded firms had the lowest performance ratings and worst caregiver experiences. That's not theory. It's families reporting fewer visits, slower response, and care that felt thin. Staffing is the first lever. Skill mix drifts from seasoned RNs to lower-cost LPNs and aides. Ratios widen. A nurse who handled 8 patients now carries 12. You still get compassion, but with less time. Burnout follows, then turnover, then a patchwork of travelers who don't know the family's rhythms. The spreadsheet frames it as operational efficiency. At 2 a.m., it's a call that rolls to voicemail while a daughter waits for guidance on her father's breathing. Drug formularies offer another quiet bend. Step therapy requires trying cheaper meds first, even when clinicians know a pricier option will likely work best. Days slip while the trial runs. For an end-of-life patient, those are days of pain or fog that never come back. If the chain owns the specialty pharmacy too, savings accrue inside the house. A small clip on cost per script multiplied across thousands of patients becomes a quarter's worth of margin. Then there's prior authorization, ostensibly to curb low-value care. In practice, it's often delay by design. Requests bounce for insufficient documentation. Denials arrive on a Friday. Appeals take weeks. Meanwhile, the need either resolves, escalates to an ER visit, or becomes moot because the window closed. Each additional form shifts a sliver of cost off the plan and onto the family's time, energy, or wallet. The denials that are overturned still serve their purpose. They slowed spend. You see the same pattern in how observation status gets used. Here's a microstory. Maria's 82-year-old mother falls, hits her head, and spends 2 nights on a hospital floor. The care looked like an inpatient stay. But the chart says observation. Medicare treats that differently. No 3-day inpatient stay, no automatic skilled nursing coverage after discharge. The bill lands at home. The hospice they were considering won't admit yet. Maria is told to appeal. She writes letters, waits on hold, Googles acronyms. Weeks pass. The appeal fails. She pays on a credit card and adds interest to grief. Inside organizations, dashboards make the pressure visible. Average visit length ticks down by 2 minutes. Great job. Crisis care hours slip. Optimize resource deployment. Denial rates hold steady. Appropriate utilization management. A clinician's judgment still matters, but it's framed by targets that arrived from a spreadsheet. A home health PT who wants an extra week of sessions knows the plan's cap. A hospice social worker who wants a second visit this week knows the caseload. Everyone learns the edges and colors inside them. When incentives run through vertically integrated chains, the nudges align. A clinic codes a few more diagnoses. A Medicare Advantage plan's risk score rises. Revenue per member goes up. The same parent company's home health agency receives a referral earlier. Length of stay expands. The hospice, also inside the system, is looped in sooner, but visit intensity gets tuned to the per diem. The pharmacy benefit manager favors formulary options that keep costs down and rebates up. Nobody writes, "Let's deny comfort." They write, "Let's standardize pathways." The effect is the same. Families encounter a maze. Network adequacy means the preferred hospice is out of plan. Medical necessity means the equipment arrives next week. Tier exception means hours on the phone. Every delay extracts something. Time from caregivers, energy from patients, dignity from moments that should feel personal. Small frictions add up to a shove. Clinicians push back where they can. They appeal denials, stretch visits, bring their own blankets. But attrition wins too often. The 2024 hospice research captured it in numbers. Caregivers at private equity, owned and publicly traded hospices rated communication, symptom relief, and overall experience worse than at nonprofits. The stories behind those ratings are simple. Fewer touches, faster discharges, thinner support on weekends, and a sense that someone somewhere was measuring minutes instead of needs. None of this requires malice. It requires incentives that reward trimming the edges of care. Flat fees versus spiky costs. Documentation that pays more when sickness is coded aggressively, but care that pays less when sickness gets expensive to treat. Prediction that flags low-impact visits, and staffing that follows suit. 1,000 tiny bends, each justified, all pointing in the same direction. The past already warned us about what happens when finance meets mortality. Long before pension risk transfers and AI underwriting, a smaller market tried to turn death into yield. It started with Viaticals, and it didn't end well. Securitizing mortality, from Viaticals to longevity. The first time Wall Street tried to turn dying into a cash flow, it started in living rooms. In the early 1990s, Viatical settlements offered men with AIDS quick money. Sell your life insurance policy for a discount. Use the cash while you're alive, and the investor collects when you pass. The model assumed a short horizon because treatments were limited. Then medicine changed. New therapies extended lives by months, then years. Forecasts missed, premiums piled up, funds ran short, and what looked like a merciful arbitrage turned into a pricing failure that bled both investors and sellers. The lesson was blunt. Small errors in mortality timing become big losses when premiums meter every month. The industry recalibrated as life settlements. Instead of a disease-specific bet, buyers fanned out across seniors with enforced life policies. Underwriters layered in medical reviews, prescription histories, and actuarial curves to estimate time to maturity. Investors paid policyholders more than surrender values, promised professional management, and tried to smooth out the volatility across pools. But the core truth remained: returns hinge on timing. If policyholders live longer than projected, premiums eat yield. If they pass sooner, the fund looks brilliant. A few months either way, multiplied across thousands of policies, decide careers. While settlements professionalized one corner, the bigger securitization wave moved to pensions. Corporations facing volatile obligations found a partner. Insurers willing to assume pension promises in exchange for assets. That's the pension risk transfer. It didn't stop there. Insurers, holding longevity risk, the chance retirees live longer than expected, offloaded slices to reinsurers. By 2024 to 2025, many of those reinsurance platforms were linked to private equity and parked in jurisdictions like Bermuda that allow capital-light structures. The math is clean on a whiteboard: move risk to where it's best held. In practice, it means a retiree's lifespan becomes a line on a swap, a block in a treaty, a spread on a balance sheet. Banks, insurers, and funds then built longevity swaps to trade exposure. If a pension plan fears its retirees will outlive assumptions, it pays a counterparty who agrees to cover excess payments if that happens, in return for a fee. The hedge looks tidy until models shift. Because everything rests on expected survival curves, any new information, an updated mortality table, an AI signal, a drug breakthrough, can push valuations hard. That's where the prediction engines from earlier sections meet market structure. The same machine learning that flags a hospice census swing helps a reinsurer recalibrate tail risk. One algorithmic tweak that adds 6 weeks to expected life across a book can erase years of outperformance for a fund built on tight spreads. Compare it to catastrophe bonds, and you see why mortality got tempting. Hurricanes are spiky and seasonal. Death, at a population level, is smoother. So capital flooded to biocash exposures that behaved like slow-moving, uncorrelated yield. But correlation always finds a way in. A severe flu season, a pandemic shock, a drug that meaningfully extends time to event in heart failure. Each ripples across trillions in present value. What looked safe turned sensitive. Investors didn't just rely on public tables. They built granular models, the kind that use diagnosis codes, pharmacy fills, and procedure histories to refine survival estimates. Academic work, including Stanford-linked efforts, showed how to get high discrimination on one-year mortality with routine data. Funds applied similar tools to price life settlements. Reinsurers used variance to set reserves, and banks used them to structure swaps. That's the amplification risk. When everyone tightens their curve with the same signals, a shared error moves the whole market together. Think of it as actuarial crowding. We've been here before. In the 200s, mortgage securitization convinced itself that housing declines would be local and offsetting. Models clustered around shared assumptions. When those broke, the instruments tied to them broke too. Mortality securitization carries a quieter version of that risk. The spreads are slimmer, the maturities longer, the counterparties better capitalized. But the hinge, forecasting the future of bodies with math, still swings. There's a human echo running underneath. Viaticals were personal, you met the seller. Life settlements added distance. You saw a policy ID and a projected curve. Longevity swaps moved the view even farther back. You saw a cohort, a liability, a hedge. Each step improved efficiency and diffused responsibility. It also made it easier to forget that duration extension means a person lived longer, which is good news for them and a problem for a spreadsheet. When AI models push that extension into reserve calculations, they don't feel the birthdays, they feel the basis points. So the arc goes like this. A failed bet on short horizons taught humility. A professionalized market demanded better forecasting. A global search for yield turned lifespans into tradable exposures, and machine learning sharpened the blade that cuts both ways. The newest lesson is the starkest. The more precisely we can price mortality, the more valuable it becomes to own the levers that influence it. That's why the next wave isn't just about securitizing death. It's about selling more years and deciding who pays for them. Monetizing more years, the longevity industrial complex. If turning death into yield was one pillar, the other is selling more years as a subscription. That's where the longevity industrial complex comes in. Clinics that promise optimization, Memberships that bundle labs and coaching, diagnostics that turn your blood into a quarterly report, and apps that convert daily steps into actuarial inputs. The pitch is simple and seductive. Stay younger longer. The business model is steadier, annual recurring revenue. Start with the private clinics. They don't call themselves that. They're performance medicine, age management, precision health. For a few $1,000s a year, you get baseline labs, hormone panels, VO2 tests, and a plan. Sleep more, lift heavier, maybe adjust testosterone or thyroid. Some add GLP-1 prescriptions for weight, marketed as metabolic reset. Others dangle experimental senolytics in the pipeline, promising to clear zombie cells when regulators bless them. The aim might be noble. The economics are clear. Each lab, each consult, each refill feeds a membership that auto-renews. Then layer diagnostics. Full-body MRI packages sell peace of mind at $2,000 a scan, annualized. Liquid biopsies screen for cancer fingerprints in blood. Still controversial in primary care, but compelling to anxious high earners. Biomarker panels track inflammation, lipids, hormones, micronutrients, repeated every quarter for trend visibility. The more you test, the more you find. The more you find, the more you treat. The more you treat, the more you bill. Abnormal becomes a product. Investors understand the pattern because it looks like software. Predictable cash flows, upsell ladders, churn metrics. A patient starts with a $199 monthly membership. Add a $1,200 annual MRI, a $300 quarterly panel, and a $600 nutrition add-on. The clinic monetizes not just illness but vigilance. And because insurance covers little of it, the sales pitch skips prior auth and goes straight to credit cards. That's margin without payer friction. Pharma sits just next to this lane with products that straddle medical need and lifestyle demand. GLP-1s, born as diabetes drugs, now ride an obesity wave. For an investor, they turn a behavior change challenge into a long-duration therapy. If adherence sticks, so does revenue. Longevity narratives extend to supplements. NAD boosters, resveratrol blends, mitochondrial cocktails, where evidence ranges from promising to thin but marketing runs hot. Each bottle is a small annuity. Data is the quiet foundation. Wearables record heart rate variability, sleep stages, steps, glucose spikes. Health apps coach habits. Employers subsidize programs that lower claims. But the same data that nudges healthier choices can also feed underwriting in everything but name. Plans won't say they use your watch to price you. They will, however, design incentives that sort people into risk buckets, then tilt premiums or network design accordingly. Wellness becomes a proxy for willingness to be watched. Direct-to-consumer labs complete the circuit. Startups promise actionable insights in glossy dashboards. They partner with telehealth prescribers who can adjust protocols on the fly. They partner with insurers for pilot programs. They partner with employers to reduce absenteeism. The lab results, the adherence scores, the consult notes. Each is data that becomes collateral. If you're an operator, that stream improves retention and cross-sell. If you're a payer, it improves risk segmentation. If you're a private equity owner, it improves exit multiples because you can show subscription growth and engagement. There's a deeper irony here. Living longer should be free upside. But in a system that tolls every gate, more years can mean more rent. More years in a senior residence with annual escalators. More years paying premiums that drift up. More years buying supplements and scans. More years where your data justifies your price. For households with savings, that's manageable. For households without, it's pressure, because the same services that promise prevention can also widen. The gap between those who can prepay health and those who can't. The marketing leans hard on fear and aspiration. Don't miss hidden disease. Train like a pro. Unlock your biological age. It lands because the alternative, waiting for symptoms, feels risky. But the emotional charge also blurs consent. Did you really choose to share continuous glucose data with a benefits platform? Or did the discount on premiums make it feel mandatory? Did you agree to a life insurance rider that adjusts with wellness participation? Or did you sign a stack of forms? Consent gets fuzzy when savings are at stake. There are good actors here. Clinicians who use data to catch problems earlier. Coaches who help people sleep, eat, and move better. Patients who feel stronger at 70 than they did at 50. Healthspan matters. But the financialization sits alongside it. turning better habits into new revenue lines and using engagement to justify more intense data capture. The slogan is personalized care. The ledger reads predictable ARR. Follow the ownership and you find familiar names. Private equity funds back multi-site concierge clinics. Health systems spin out optimization programs. Insurers sponsor wellness platforms and then collaborate on program design that contours to their risk models. Banks publish theses on the longevity economy. Asset managers point to Americans 55 and older sitting on more than $124 trillion in household wealth and call it a secular tailwind. The message to capital is constant. The cohort is rich, the need is rising, the subscriptions are sticky. If you step back, the two pillars meet. On one side, death is managed as yield with per diems and leases. On the other, life is extended as subscription with diagnostics and memberships. The same players can touch both lanes, routing patients through end-of-life funnels while capturing years of wellness spent earlier. That's vertical integration across time. And the bill comes due in the one place that doesn't have shareholders, the household budget. Household squeeze, how this hits your wallet. You don't feel consolidation on an earnings call. You feel it in bills that arrive when you're tired, scared, or grieving. Start with premiums. Plans point to rising input costs and sicker populations, but there's another layer now, dynamic pricing. AI-driven underwriting segments risk with more precision, then passes it through in the form of tighter networks, higher deductibles, and wellness discounts that are really penalties if you can't or won't share data. Two neighbors, same age, similar health. One uploads wearable metrics and finishes a digital coaching program, the other doesn't. Next year, one pays less, one pays more, and neither can quite explain why. Out-of-pocket caps drift higher at the same time. The number looks protective until you discover what doesn't count toward it. Prior authorization delays kick treatment into a new year. Observation status makes a hospital stay look outpatient on paper. Brand switches under step therapy extend a problem without fixing it. Each tactic scrapes a little off the insurer's cost and leaves a little more on your side of the ledger. The model calls it appropriate utilization. You call it another call to customer service. Senior housing compounds the squeeze. Median retirement income hasn't kept pace with rent escalators and ancillary fees. A one-bedroom in assisted living might start within reach, but annual increases of 4 to 6%, plus add-ons for medication management, bathing assistance, and transport, push it out of reach in a few years. Families fill the gap until savings run dry, then face choices nobody wants. Move a parent mid-decline, liquidate assets, or negotiate with a business office that has a policy and a wait list. Operators point to staffing costs and insurance. They're not wrong. But leases to REITs with fixed escalators leave little room to bend when a family needs a month. Funerals and cremation hit when you're least able to shop. In markets where roll-ups quietly own multiple homes, list prices climb together. Basic cremation used to be a low four-figure expense. Now it's higher, with required fees and service charges that didn't exist a decade ago. Caskets and urns cost more, obituary placements add surprising sums, and facility fees appear for simple viewings. You can push back, but most people don't. Grief shortens patience, and decisions need to be made. The upsell meets a vulnerable moment and wins. Medical debt follows like weather after a cold front. Even small balances at high interest turn into long shadows. A denied claim for equipment, a gap between in-network and out-of-network rates, a lingering balance from observation status. Each one can be sold to a debt buyer. Letters arrive. Phone calls start. If the file moves to collections, credit scores fall. That changes mortgage rates, car insurance premiums, and job prospects. A hospital charity office might help if you hit the right threshold, but you have to know to ask, and you have to ask fast. Geography decides more than we admit. In counties where hospice or funeral competition has thinned, prices behave like they're coordinated even if nobody meets in a back room. Families drive farther for a lower quote, where they accept what's local and pay more. In home health deserts, agencies triage by reimbursement rate and staffing load. A Medicare Advantage member with a plan that pays less might wait longer. A traditional Medicare enrollee might move faster. Nobody says it out loud. It shows up in who gets the Tuesday slot. Dynamic underwriting widens gaps at the edges. If your pharmacy adherence slips because you're juggling 2 jobs and a parent's appointments, the model reads non-compliance. not overload. If your zip code correlates with higher readmission rates, your plan design's narrow. If your wearable opts out, your premium relief disappears. The algorithm doesn't see care burdens or shift work. It sees risk signals. Decision fatigue is a profit center here. End-of-life choices stack when you're least able to parse them. A discharge planner rattles off 3 hospice options. You pick the one your plan prefers. A funeral director offers a package. You nod because the room is quiet and you want to be done. A senior residence hands you a new fee schedule. You sign to keep your mother's room. At each point, there's a cheaper path that's harder to find, requires 3 more calls, and asks you to go against the grain of a system designed to route you quickly. The feedback loop we traced earlier closes at your kitchen table. Pension contributions and premiums fund investors who own the operators who bill you. REIT dividends are financed by your parents' rent escalator. PBM rebates are financed by your higher list price before the discount. Reinsurance profits depend on mortality curves that your plan's care pathways can nudge. Nobody writes the loop on a statement. You feel it as, why is this all so expensive now? There are levers. You can ask for itemized funeral price lists, compare hospice CHPS scores, and appeal observation status. You can push a plan to review underwriting manually if an AI adjustment feels off. You can coordinate among siblings to keep a parent at home longer with shared schedules. But those are countermeasures, not fixes. The structure is doing what it was built to do: turn the last miles of life, and the years leading up to them, into dependable yield. The costs land where they always land, in the hours you don't have, the dollars you thought would be capital enough, stack, and the quiet moments you wanted to save. Follow the money upstream, and the story stops being abstract. The limited partners, the LPs, are pensions, endowments, and insurers managing other people's futures. Teachers, firefighters, nurses, city workers. Their savings pour into private equity funds and credit vehicles that promise steady returns uncorrelated to markets. The target? Exactly the operators downstream that bill those same retirees and their families. It's a loop that pays twice, once in contributions, once in invoices. General partners, the GPs, sit in the middle, taking management fees on committed capital and performance fees on gains. They buy fragmented end-of-life operators, layer on leverage, and push the classic levers. Back-office consolidation to cut costs. Sale-leasebacks to extract real estate value, moving buildings off the operator's balance sheet and into a landlord's with rent escalators locked in. Debt refinancings that juice cash flow today and tighten collars tomorrow. The spreadsheet calls it value creation. Patients and residents pay it as line items. Sale-leasebacks deserve a beat. A hospice chain or senior living operator sells property to a real estate investment trust, books a gain, and signs a long-term lease with annual bumps. Cash hits now, obligations hit every year. When labor or supplies spike, the rent doesn't blink. If occupancy dips, the rent doesn't blink. Families may never learn the REIT's name, but their monthly statements fund its dividend. Public REITs love this predictability because Wall Street pays for it. The dividend grows because your mother's rent rises on schedule. Vertical integration magnifies the capture. Optum's sweep, from clinics to home health and hospice to a pharmacy benefit manager, tightens the rails we traced earlier. Owning the referral points and the billing pipes means fewer revenue leaks. PBMs extract spreads between list prices and net prices after rebates. Those rebates become margin while employers and patients face higher sticker shock at the counter. When a chain controls the PBM and the dispensing, it captures both sides of the same prescription. That's how a formulary decision somewhere in a corporate office turns into a copay conversation in a kitchen. Risk doesn't vanish in this machine, it moves. Insurers who take on pension obligations park longevity exposure with reinsurance affiliates, many domiciled in capital-light jurisdictions like Bermuda. Those affiliates are often linked to private equity sponsors. Capital relief lets the parent write more business or deliver steadier earnings. The mortality models set reserves. Small shifts unlock or lock up billions. On paper, it's efficient allocation. In practice, it's opacity. The retiree whose check arrives on time doesn't know a Bermuda treaty smoothed the path. The same retiree's premium dollars, paid for decades, now support platforms that own the hospice they'll later use. Fees stack along the way. GP management fees skim before any improvement shows up. Transaction fees charge portfolio companies for the privilege of being bought. Monitoring fees bill them for oversight. When operators refinance or sell real estate, bankers and lawyers take their slices. None of those costs show up as finance on a resident's invoice. They show up as community fee, care coordination, transport, rent escalation, and pharmacy difference. Now line up the incentives. Leverage pressures operators to hit quarterly covenants. That means occupancy targets, length of stay targets, visit minute targets. Miss them and lenders call. Hit them in G-piece markup valuations. LPs see a tidy chart. They rarely see the midnight phone calls to find a weekend nurse or the extra form that turned an inpatient stay into observation. The beauty of the stack is that it keeps the human mess far from the capital narrative. The PBM channel deserves its own line item in this stack because it's where list prices and rebates play a shell game. A brand drug's list price climbs. The PBM negotiates a larger rebate. Net costs can fall for the plan while patients with coinsurance pay a percentage of the inflated list. The spread becomes revenue for the integrated parent. When the same corporate family owns a Medicare Advantage plan, a clinic, home health, and the PBM, the flows align. The savings that show up on one P&L often reappear as higher out-of-pocket costs for a patient somewhere else. Add dividends to round it out. Public REITs distribute cash sourced from rent checks that rise because contracts say so. Those checks are paid by residents whose incomes don't rise because reality says so. Pension funds buy those REIT shares for yield, applauding the stability. The beneficiary who earns that yield on paper might be the same person writing the rent check to the operator inside the REIT's portfolio. This is the feedback loop in plain terms. Your premiums and contributions finance funds that acquire the providers, who route your care and set your prices. Their profits show up as higher valuations, dividends, and fees upstream. Their costs show up as denials, delays, and escalators downstream. It's not a conspiracy. It's plumbing that works as designed. Regulators see pieces of the mosaic, but rarely the whole picture. State boards watch funeral homes. Health departments oversee hospices. Insurance commissioners review rate filings. Bank regulators track capital. Antitrust lawyers weigh market share. The integration lives between those lines in referral patterns, lease clauses, reinsurance treaties, and data sharing agreements that individually look normal and together set the terms of modern aging. From a balcony view, the capital stack looks elegant, diversified, hedged, yield-generating across cycles. From a couch where a daughter sorts bills, it looks like a maze that charges rent at every turn. The profits are real. So are the payers. And they are often the same people. Regulations blind spots and flashpoints. If you try to regulate this machine piece by piece, you miss the way it moves. Start with funerals. States license directors and inspect facilities, but oversight is fragmented and dated. Price transparency rules exist on paper, yet enforcement is thin and fines are trivial compared to revenue. When chains buy local homes and keep legacy names, there's no bright red consolidated label. Families don't know they're choosing within the same corporate family, and regulators rarely flag common ownership unless a violation stacks up. Hospice oversight lives in another silo. Medicare certifies providers and collects caregiver experience surveys, but acquisitions race ahead of ownership reporting. Private equity stakes are layered through LLCs, nameplates stay the same, databases lag. By the time a state realizes a regional cluster sits under one sponsor, referral patterns are already locked in. When complaints spike, penalties land months later, often as corrective plans that tweak documentation rather than staffing or visit intensity. The incentive to shave minutes remains. Medicare Advantage sits on a federal rail with its own blind spot, coding intensity. Regulators know plans document more diagnoses and have tried to claw back overpayments. Audits and risk adjustment data validation exist, but they're slow, contested, and retrospective. Meanwhile, the money flows in real time. Prior authorization reforms nibble at edges, asking plans to publish criteria and speed decisions, yet denials still arrive on Fridays and appeals still take weeks. The friction that saves plans dollars doesn't show up as a headline number in rate filings. It shows up as Tuesday phone calls nobody logs. Certificate of Need laws were meant to prevent overbuilding and protect access. In practice, they often entrench incumbents. If a region's hospice market is already dominated by a few operators with hospital ties, new entrants face hearings, local lobbying, and long timelines. Chains learn the terrain and defend it. Families hear rhetoric about avoiding duplication of services. They don't hear how the rule cements referral funnels. Surprise billing reforms landed hard in emergency and anesthesia, but end of life has gaps. Observation status still turns what looks like inpatient care into outpatient billing. Post-acute transitions remain a thicket of in-network versus out-of-network traps. A family at a bedside doesn't parse the No Surprises Act. They sign a form about facility policies. If they contest a bill, they wander across agency lines, state insurance, federal CMS, hospital ombuds, each saying politely, "That's not our lane." Antitrust focuses on national share for big mergers and sometimes misses the ground game. 2 funeral homes in one county quietly sharing a parent won't trip a DOJ alarm. A hospice roll-up that takes 3 bites over 5 years can avoid thresholds that trigger deeper review. Vertical deals, clinic to home health to hospice to pharmacy, look harmless in isolation. Only when you see the routing data do you understand how market power shifted. Most enforcers don't get that data unless a whistleblower risks a career. Reinsurance sits offshore by design. When an insurer transfers pension longevity risk to an affiliate in Bermuda, capital relief improves balance sheets. State commissioners review solvency and consumer protections at the parent level, but the treaty details live in a place with different rules. If mortality models shift and reserves tighten, the adjustment is an accounting event to regulators, not a care event to households. Yet those reserves and yields influence how aggressively an integrated system manages claims and denials downstream. Flashpoints keep appearing where rules don't meet reality. One is ownership opacity. Caregivers and families can't easily learn whether a hospice is private equity, backed or part of a vertically integrated chain. Publishing real-time ownership maps and linking them to quality scores would turn a blind spot into a signal. Another flashpoint is data dignity. Plans argue they don't underwrite with wearables, they incentivize. Consumers feel coerced. A clear line on what data can move premiums, and a right to opt out without penalty, would match modern tools. There's also the matter of audit speed. Medicare Advantage audits arrive years after claims. They need to be closer to live, with sampling that reflects predictive coding practices. Publish denial and overturn rates by plan, by service category, so clinicians and families can anticipate pain points. Tie star ratings to response times for hospice crisis care, not just documentation scores. Antitrust can sharpen its lens to local and vertical patterns. Instead of national shares, map referral captures in hospital discharge corridors. If one parent company controls the discharge planner's list, the home health agency's intake, and the hospice's census, the effective market is closed. That can be remedied with behavioral remedies, firewalls, fair referral requirements, or, if needed, with structural fixes. Finally, treat end of life like infrastructure. Require plain language, itemized funeral price lists posted online with standardized definitions. Mandate real-time disclosure of hospice staffing ratios and weekend coverage. Force REIT-linked operators to disclose lease escalators affecting resident fees. Make the invisible levers visible, so choice is real when it matters most. Regulators aren't villains here. They're outpaced. The finance side iterates quarterly, the rulebook moves in years. Until that gap closes, the mosaic will keep slipping through, and households will keep learning the rules one painful invoice at a time. 3 breaking points, case-led deep dives. Start in a river town where the hospital sits on a hill and the mill closed years ago. 3 years back, a private equity fund stitched together 2 local hospices and a home health agency. The names stayed, the owners changed, the dashboard arrived. Admissions climbed, length of stay stretched, and visit intensity ticked down. Nurses felt it first. 12 patients became 14, then 16. The scheduler apologized, the targets didn't. Weekends got thin. Families started noticing callbacks instead of visits. Here's one family's week. David's father, Earl, a retired lineman with lung disease, finally agreed to hospice after a 3rd ER night. The discharge planner, tied into the system's preferred providers, circulated 1-page sheets. 3 options, 2 logos, 1 parent. David picked the one the nurse recommended. The first days felt steady. A nurse every other day, meds sorted, a bath aid once. Then Saturday night hit. Earl couldn't breathe. David called. The national line answered, promised to page the on-call nurse. 45 minutes later, a nurse new to the case arrived, kind but rushed, juggling 3 homes across 20 miles. She stayed 30 minutes, charted on her phone, and ran to the next call. Across the county, experiences echoed. The local paper ran letters. Pastors compared notes. When the 2024 research dropped, teams from Emory, Vanderbilt, and Cornell showing private equity, owned and publicly traded hospices posting the lowest performance ratings and worst caregiver experiences, it felt like confirmation. Communication scores were lower. Symptom relief felt slower. Caregivers rated overall experience worse. The agencies defended their numbers, pointing to staffing shortages and documentation fixes. Families heard math when they wanted time. Clinicians tried to push back. One nurse, Janet, kept a spiral notebook with every delayed call, every missed supply. She brought it to a supervisor who circled the per diem budget. Optimize crisis hours, the email said next week. The chain announced a care coordination enhancement. Less RN time, more telesupport. On paper, it preserved touchpoints. In Earl's living room, it shaved minutes off the only visits that mattered. Drive 2 hours west to a county with 1 main road and 2 funeral homes. Different names, 1 parent company. The owners sold during the pandemic, kept their signs, and started sending calls to a centralized cremation hub 40 miles away. Lisa's mother died on a Wednesday. She Googled, called both homes, and got similar quotes. Basic cremation, a few thousand. Required fees for transportation and processing. Add-ons for witnessing and obituary placements. Lisa asked for an itemized list. Both directors promised to email standard packages. The PDFs matched down to the footnotes. At the arrangement table, the director talked through options in a practiced, gentle cadence. The urns sat at eye level, the cheaper models on a lower shelf. Lisa said no to viewings, but a facility use fee remained. She pushed back and watched the director hesitate, then check with billing, then remove it with a smile. If she hadn't asked, it would have stayed. The laminated price. She did its quiet work. When she picked up her mother's ashes, she heard another family in the lobby asking the same questions with less energy. One town over, a pastor told a story from the pulpit about a veteran's family paying interest on a funeral loan. The director called the pastor the next day. Margins were up, staff got raises, prices reflected industry standards. Both statements were true. The county board asked the state for help on price transparency. The state sent a memo. Nothing changed. Now a city suburb where a senior living tower gleams over a strip mall. The operator doesn't own the building, he does. Leases escalate 3% annually, plus CPI caps. The business office prints new fee schedules every January. Mary moved her husband, Tom, into a 1-bedroom with memory care support. It fit their budget at first. Year 2 brought a 5% rent bump and a care coordination fee. Year 3 layered medication management and high fall risk monitoring. Mary asked what had changed. Documentation requirements, the director said. We're just aligning with best practices. Mary's social security check hadn't aligned upward. She sold a car, then a mutual fund. When she asked about reducing services, the director warned about network adequacy and liability. She called 3 nearby residences. 2 were full. 1 was owned by the same operator with similar fees. Moving Tom risked confusion and decline. She stayed and clipped coupons. At bingo, she met Janet, another spouse, who'd started a covert spreadsheet tracking neighbors evicted after falling behind. The pattern was brutal: late fees, payment plans, quiet departures at month end. In the background, the same rails from earlier sections hummed. The operator's PBM partner tweaked Tom's formulary. A cheaper alternative left him drowsy. The Medicare Advantage plan delayed an equipment request. The appeal succeeded after 3 weeks and 3 calls. The hospice liaison dropped by, wearing a polo with a logo tied to the health system. Early engagement helps, she said. Mary nodded, holding the new fee schedule like a bill of lading. These 3 places, Rivertown Hospice Roll-Up, Funeral Monopoly County, RIT-linked residents, aren't outliers. They're the lived version of a thesis. Optimization toggles moved. Fewer weekend nurses, centralized cremation, rent escalators, formulary nudges. Lives bent around targets set far away. Caregivers rated lower because they felt the squeeze. Families paid more because choice narrowed. And inside all 3, predictive tools nudged the path. Who got called first, which funeral package loaded on a screen, which resident tripped a high acuity fee. There's no villain monologue in any of these rooms. There are people doing their jobs inside incentives. That's what makes the breaking points feel so ordinary. A voicemail on a Saturday night, a fee on a laminated sheet, a rent letter in January. Each by itself looks small. Together, they mark the line where care meets yield and where households absorb the difference. Defensive playbook, reclaiming agency. Let's get practical. If the system is wired to turn years into yield, your first job is to slow the charge at your door. Start with an audit. Pull every active policy, health, Medicare Advantage or Medigap, long-term care, life insurance. List network rules, prior authorization triggers, appeal windows, and who answers after hours. Keep a denial log with dates, names, and reference numbers. Patterns appear fast when they're on paper. Hospice choice is yours, not the hospital's. Discharge planners can suggest, but they can't force a provider. Before signing, check CHBS hospice quality scores and recent caregiver reviews. If ownership isn't obvious, ask directly. Are you owned by private equity or a health system? If you hear we're locally managed, ask again. Who owns the parent? If the answer stays fuzzy, treat it as a flag and compare another agency's scores. Prioritize response times, weekend crisis coverage, and RN visit frequency over branding. Advanced directives remove guesswork others can monetize. Put a healthcare proxy, living will, and DNR or PULSD in the chart and on the fridge. Share copies with the primary care doctor, the hospital, and the likely hospice. Write down preferences that fall between the lines. No ambulance for non-urgent issues, no ER transfers for manageable symptoms, who to call first at night. Clear instructions protect time and prevent billable detours you didn't want. Pre-need funeral planning is unglamorous and powerful. Ask 3 homes, ideally including a nonprofit or cooperative, for itemized price lists. Insist on the general price list, not packages. Decide now if you prefer direct cremation or burial, and where. Pre-authorize funds in a payable on death account instead of a high markup insurance policy. If the chain owns multiple homes under different names, leverage that knowledge. I know both options share. A parent. I want the lowest facility and processing fees you offer anywhere. Senior housing contracts hide risk in add-ons. Before move-in, ask for the full fee schedule, not just rent. Which services trigger new charges? How are annual escalators calculated, fixed percent or CPI capped? What are discharge, eviction, and community fee terms? Negotiate in writing for caps on annual increases, a freeze on add-on fees for 12 months, and a grace period before any eviction action. If they won't cap, ask for a rent credit or a step-down clause tied to occupancy. Bring a witness to the signing. Insurance literacy saves real money. If you're on Medicare Advantage, know your plan's appeal timelines cold. File a fast appeal for care denials and ask your doctor to write a necessity letter within 24 hours. Track prior authorization deadlines and escalate when clocks run. If your premiums jump or benefits narrow after wellness nudges, ask for a manual underwriting review and request the specific non-medical data used. If you're choosing at 65, compare MA versus Medigap with a sober eye. Medigap costs more upfront, but often buys wider access and fewer denials when stakes rise. AI-driven underwriting is quiet until it's not. If you're offered discounts tied to wearables or continuous monitoring, ask how data will be used now and in the future. What happens to your premium if you opt out? Is the data de-identified? Can you revoke consent and purge historical feeds? If answers are mushy, firewall your health data. Use devices without insurer integrations, keep nutrition and sleep apps off shared employer portals, and separate emails so marketing graphs can't triangulate your identity. Document every denial, delay, and downgrade. For prior auths, request clinical criteria in writing and match your physician's notes to each bullet. For observation status, ask the hospital case manager daily if status changed and why. If a 3-night inpatient stay is needed to qualify for skilled nursing, make that explicit in writing before discharge. When appeals fail, escalate to the plan's medical director and copy your state insurance department or CMS ombuds with dates and case numbers. Bureaucracies move faster when they know someone's watching. Build local leverage. Churches, unions, and community groups can form buying clubs for end-of-life services. Negotiated cremation rates, transport fees, and simple service packages. Pooling demand makes transparency less optional. Share hospice CHPS comparisons at senior centers and caregiving groups. Publish a community spreadsheet of weekend response times and crisis care availability. Small reputational daylight changes behavior faster than faraway penalties do. Prepare the paper that keeps families out of court and debt. Update beneficiary designations and payable on death titles so assets transfer outside probate. Store a digital vault with logins, policies, advanced directives, and a one-page first steps note for the day something happens. If you carry life insurance, verify premium schedules and grace periods, and set up calendar alerts. Missed payments under stress wipe out decades of planning. Automation protects against the week everything blurs. When selecting a hospice, script the intake call. How many RNs cover weekends? What's your average time to an in-person crisis visit at night? How many patients per RN this month? Are you currently under any corrective action plans? If answers dance, move on. If they give specifics, and invite you to call their on-call line to test response. You've found a culture that understands why minutes matter. Don't fight alone. Caregiving is a full-time job layered on life. Divide roles among siblings and friends. One handles insurance calls, one tracks meds and refills, one organizes respite. Set a weekly 20-minute huddle. Write down who's on point for appeals, equipment pickups, and weekend check-ins. Use shared notes so every question and answer sticks. Systems count on you dropping a ball. A small team drops fewer. Last, remember the quiet power of no. No to data sharing you can't unwind. No to packages you didn't ask for. No to discharge without services confirmed. No to being rushed when a signature turns into a bill. You won't win every round, but each no slows a machine that profits from your hurry. Offense buys back reducing lifetime rent to the system. Defense buys time. Offense lowers the bill across years. Start with the compounding lever that doesn't need an app. Healthspan basics. Sleep 7 to 8 hours in a dark, cool room. Same bedtime, same wake time. Strength train twice a week with full body movements. Squats, hinges, pushes, pulls. Walk daily. 8,000 steps beats 0 gadgets. Keep protein high, ultra-processed food low, alcohol light. These aren't vibes, they're actuarial. Fewer hospitalizations, fewer meds, slower functional decline. Every avoided claim is a toll you didn't pay. Now firewall your data. Insurers and employers frame wearables as wellness. Ask 3 questions before you sync anything. Can I get the same premium without sharing? How is the data stored and who sees it? What's the deletion policy? If answers wobble, keep your health streams off connected portals. Use devices in standalone mode, separate emails for health apps, and a credit card not tied to HSA/FSA rails to avoid triangulation. Turn off location for pharmacy and health apps. Don't post lab screenshots with barcodes. Your future price is hiding in today's engagement. Structure your finances to preempt fee cascades. If you're HSA eligible, max the HSA and treat it like a health Roth. Invest the balance in low-cost index funds, pay current bills from taxable cash, save receipts in a cloud folder so you can reimburse tax-free later. Pair that with an emergency buffer earmarked for deductibles and denial appeals. 3 months of typical out-of-pocket spend avoids credit card interest on observation status surprises. If you're buying life insurance, ladder-term policies that end before retirement age. Skip quirky riders unless caps and exclusions are in writing and understandable in one read. Long-term care is a minefield. If you buy it, cap exposure. Look for simple benefit structures. 3-year benefit period, meaningful daily maximum, inflation rider you can actually afford. Reject policies that hinge on opaque wellness participation. If you can't get comfortable, build a dedicated LTC fund inside a conservative allocation and revisit every 2 years. Families can also establish a caregiving compact, a written, notarized agreement where adult children are compensated for care hours at a fair market rate. It formalizes work, avoids resentment, and can satisfy Medicaid look-back rules if designed properly with counsel. Estate prep shrinks admin rent. Keep beneficiary designations current on every account. Add payable on death and transfer on death to bank and brokerage accounts to bypass probate. Title the house to match your state's simplest transfer path. Maintain a 1-page ICE document. Key contacts, policies, accounts, and first 48-hour steps. Store it in a digital vault with access shared to 2 trusted people. Add a letter of intent for non-financial wishes. church, music, burial versus cremation. So loved ones don't buy time with money when they're unsure. Geography is a price. If you're 5 to 10 years out from needing senior services, scout counties where hospice competition exists. Funeral homes are not all one parent, and assisted living isn't dominated by a single RET. Call 3 hospices, ask weekend crisis response times and RN caseloads. Walk 2 funeral homes, ask for itemized lists at the door. Tour 3 senior residences. Read leases for escalators and add-on triggers. A modest relocation can shave 15 to 25% off multi-year costs without sacrificing proximity to family. Build a family care pact early. Don't wait for a fall. Hold a meeting with siblings and close friends. Set roles: medical quarterback, finance lead, logistics captain, respite coordinator. Rotate weekend duty. Book quarterly respite days on the calendar now. Tired caregivers make expensive decisions. Share a living spreadsheet of meds, contacts, appeals, and bills with scan and upload habits. A system beats heroics when the machine leans on you. At the doctor's office, practice friction judo. Bring a written agenda with 2 priorities and a 1-sentence history. Ask, what are the options, what are the trade-offs, and what happens if we wait 2 weeks? Request meds from the lowest cost therapeutic class first, only when clinically equivalent. Make the prescriber-owned step therapy choices, not the PBM. For imaging, ask for independent centers with global cash rates. Even insured patients can come out ahead if deductibles reset soon. Negotiate like a buyer, not a supplicant. Hospital bill? Ask for the prompt pay discount in writing before paying. Senior residence hike? Bring market comps and occupancy data. Propose a smaller increase with a 1-year extension. Funeral fee stack? Strip to direct cremation or immediate burial, then add only what you value. Use scripts that anchor low and stay kind. We want to keep mom here. If you can meet X, I can sign today. Leverage groups. Churches, unions, alumni networks, and community centers can. Pre-negotiate funeral basics, cremation transport, and simple memorial packages. They can publish hospice CHPS scorecards quarterly. They can host advanced directive nights with notaries. Collective daylight, posted prices, response time logs, changes behavior within a quarter without waiting for regulators. Finally, choose your yes. Say yes to walking, sleep, strength, and boring food habits. Yes to plain language legal papers. Yes to local maps of honest providers. Yes to pausing when a signature becomes a subscription. Offense isn't glamorous. It's a quiet refusal to fund a yield machine with your minutes and your money. The bigger picture, ethics, power, and the next pivot. There's a moral line here that spreadsheets can't see. When the same parent company predicts outcomes and owns the levers that influence them, from clinic to home health to hospice, the temptation isn't abstract. Appropriate pathways can quietly align with reimbursement. Nobody writes orders to shorten a life, but the structure rewards choices that make last months cheaper to deliver. That's the hazard, profit tied to how a life ends. Data dignity sits beside it. Plans insist wearables and apps are voluntary. Discounts turn that into pressure. Consent blurs when opting out costs money. AI mortality pricing now touches pensions, annuities, and life insurance. Most people never see the model that labels them. There's no simple appeal for a risk score. You can contest a denial. You can't interrogate a gradient-boosted tree. The asymmetry is real. They know more about you than you can ever know about the system judging you. Zoom out to families. Pensions and endowments fund private equity, which buys the providers that later bill those same retirees. Intergenerationally, assets flow up the capital stack, while costs flow down into adult children's evenings and credit lines. The $124 trillion older Americans hold is the prize and the collateral. Fees skim the transfer. Rebates, escalators, spreads. Each is a toll booth that takes a little as wealth crosses generations. Technology will push this further. Aging clocks move from lab novelty to product. Gene editing edges toward disease modification. Full body imaging gets cheaper. The surplus from those breakthroughs won't land evenly. In a system already sorted by ability to prepay health, the tools that extend healthy years become subscriptions first, access later. Actuarial AI becomes a gatekeeper. Price here, exclude there, nudge everywhere. Markets add another layer of fragility. If interest rates jump or models revise longevity upward, thinly capitalized operators can wobble. Leases don't flex, staffing does. Patients become stranded when facilities close fast. Longevity swap marks can swing when a new therapy adds months across cohorts. The very precision investors prize turns into volatility when assumptions move in sync. So where does agency live? In daylight and design. Owning care rails and prediction tools should come with duties. Real-time ownership maps, auditable models, appeal rights for algorithmic decisions, hard walls between coding incentives and bedside judgment. If you predict, you don't get to quietly control. If you control, you disclose the incentives in words a family understands. There's also a cultural choice. We can keep letting the last mile of life be an optimization problem, or we can treat it as public infrastructure, like water and power, where reliability matters more than return. That means minimum staffing guarantees, weekend response standards, plain language prices, and enforcement measured in minutes, not memos. It also means recognizing that a longer life is a public good, not a private annuity. We built tools to forecast years and bend diseases. Those tools can extend dignity or monetize it. The pivot is ours to make. The math that should buy people time is being used to meter it, turning birthdays into basis points. If you want the map of how pensions, reinsurers, and private equity stitch these rails together, watch our deep dive on the pension-to-PE pipeline next. Subscribe for clear, practical playbooks that protect your family's choices, and share this with the one person handling a parent's care right now. 1 hour today can spare them months of avoidable cost and stress.